Good evening and welcome to Winning with Winans. Frank Motek here, along with top-ranked money manager Ken Winans, the president and chief investment officer at Winans Investments at winansinvestments.com. Ken Winans, a great friend, also a market historian, the author of numerous books, including Investment Atlas 1 and 2, and Investment Atlas 3 is out, Creating Wealth Using Historical Trends, also a Forbes magazine contributor, so be sure to check out his latest article. Ken Winans also has his crypto credentials, too, so a lot to talk about this evening. We expect to hear about Bitcoin, still near its all-time high. He's also a wine aficionado, by the way, so before you know it, it'll be wine o'clock, and we'll talk about that, too. Most importantly, he is host of Winning with Winans, heard every Monday evening at 6 p.m. on your favorite station, 790 KBC, and we are doing it live here tonight, another eventful week since we were last on the air here live on Winning with Winans. This week getting off to a flying start with a blizzard of headlines. And Ken Winans, a lot to talk about here. Taking a look back at the past week, the past month, the month of May turned out to be a pretty good one for the stock market following a difficult start to the year. The S&P 500 had its best May since 1990, the largest monthly gain since November of 23. So good evening to you, sir.
Frank, you're not kidding with what you just said, buddy. I mean, it has been a blur. And, it literally coming off of the weekend. And, I end up talking to my clients a lot through the weekend. And it was just, I will continue to say that when you talk to somebody who leans one political way or another political way, it is like AM, FM radio, same language, different frequency. And how people are reviewing facts right now is mind-boggling. I mean, you're going, okay, I'm sorry, but I keep hearing this phrase, black swan, never happened before, new time in history. And I'm saying, you know what? First off, anybody using that phrase, in my opinion, in my industry, it is downright lazy. They haven't gone back and studied history far enough back. And number two, there's just no such thing. We've gone through tariffs before. We've gone through disruptive presidencies before. This has all happened before. But people need to calm down, think through their strategies, and get ready for the summer.
Ken Winans, live on the air here. So let's talk about what happened over the last week and indeed the last month, Ken. The sell in May and go away idea was not such a good idea as it turns out with that impressive rebound we saw last month.
Oh, no, yeah, absolutely. I mean, here everybody had written the year off. And, Frank, it still goes back to the main theme. And if people can just, and we're going to keep bringing it up every single time we do this show. It is Trump, tariffs, taxes, and deregulation. You know what? Those 4 years are going to define the next, whenever. And if you cannot begin to think through each one of those and how it fits into your investment strategy, you're going to be playing financial twister, meaning you're going to start off with a game plan and you're going to end up going in all kinds of half-cocked directions, not making any money, being frustrated, and all the rest of it. So, you just have to back into it. But, Frank, at the end of the day, and I'm glad we're doing a weekly show because I know with Motek on Money we cover the day's events, and they are important, but you've got to connect the dots. And I think right off the start, I'm hearing a lot of people talk about the so-called taco trade, which this perception that we're putting on tariffs and then we're suddenly backing off. And I've had to explain to some people, I said, look, I certainly was managing money through President Trump's first term, as I've done through many presidential administrations. There was volatility. In fact, just before tonight's show, I was curious about how many other years we had that were basically single-digit performance years, but were highly volatile. Well, guess what? Of the 5 we've had in the last 25 years, 2 of them one was 2018 and one was 2020. So they're really par for the course within this administration for this kind of thing. But I go back to what I said. If we can get used to the fact, and according with what we heard from President Trump, no more Mr. Nice Guy. China's going to have to come to the table. European Union's going to have to come to the table. And it's fun when I talk to people about particularly Europe. I've traveled throughout Europe, and it is true. I've seen it myself. There's not a lot of American cars there. There just aren't. They will blame quality. They will blame they're too wide. I don't think it's that at all. But yet, when you point out to people, look, and I myself drive a German car, they're free to buy them here. And so although we might not like the aggressiveness of the strategy, But he's not incorrect on these things. And I think we're going to get into some bare-knuckle tariff brawling all through this summer.
Yeah, when you do go to Europe, you do see those classic Mustangs and Corvettes, and that's the sort of thing that you do see on the streets there among the ultra wealthy in Europe. Those American muscle cars, especially, are really prized possessions there. But run-of-the-mill cars, you're absolutely right. Rarely do you see anything American made there.
No, and I mean, and often I hear the phrase, "Well, the roads are too narrow here. The big American cars won't fit." Well, that might be true, but the point is that, I mean, when I drive on the German Autobahns, which I have, and they're, by the way, a lot of fun to drive because they're great roads and you can go over 100 miles an hour. They're nice, big, wide roads. Yet again, I don't see a lot of American cars. But Frank, it's more, look, we can bash each other back and forth, but I mean, Europe for a long time, and I mean, look, as somebody who studied history, you know where a lot of these and what we call a tariff, back then they were called subsidies. We were trying to help Germany and Japan rebuild after World War II. There was concern about communism. We wanted to help, the roots of capitalism take hold. And guess what? It worked. Congratulations. That was a long time ago. And now a lot of those same exact tariffs that were put in place in the 1950s are still around today. And what I find it very, very tough on talking to anybody from Europe or from Canada is that they're just not willing to admit, guys, isn't it time just to look, we're cousins here. We need to work together. But you cannot possibly argue that Europe still needs those kind of capitalistic protections. But yet many of them think they do.
On the Air Live with Ken Winans. So tariffs certainly been moving the markets. Those easing trade tensions we saw in the month of May had that nice rally accompanying it when the U.S. and China agreed to slash tariff rates for 90 days. Seems like decades ago that happened, but it was just about a month ago, and now these issues have flared up again, impacting the markets today. So tariffs, we're going to be talking about tariffs. It looks like for the foreseeable future, Ken, and getting through that, having a strong enough stomach, which I know you have, to navigate all of this. What are your thoughts about this blizzard of tariff news and how it's buffeting the market on a day-to-day basis?
Frank, it's funny. I mean, yes, you're right. We get it constantly, and then, as I said, I get a lot of calls from clients, and it's ironic. Some of my clients who were actually born in Canada, born in Europe. And to be perfectly frank, and I hate to put it this way, but we can at 6 p.m., they're pissed. They're really mad. They feel like they've been betrayed. And I'm trying to say, wait a minute, hold it. Do you not admit, I mean, if it's not a problem, then let's just have it all go to zero right now. And then they'll bring up, well, it's complicated in Europe. We've got all the EU stuff. But there's always excuses. And it's the same thing with the Canadians. There are excuses. And I'm just saying, look, this is the problem. It's going to take, and I would say this to our audience, Frank, this is not going to be solved overnight. These are very complicated, multi-decade adjustments in international trade policies. And unfortunately, I don't think a lot of people in media, one, have the knowledge, or two, really are going to bother to do the research to be able to tell people, look, this is what's really going on. If we can simply accept the fact that most of 2025 is going to be drama-filled with tariffs. But you know what? I want to switch gears here real quick. I've been asked quite a bit what keeps me up at night. And really, it's looking at the big deal in the tax package. And I have a sneaking suspicion, for those of us who really do follow how things are, as we would say, the sausage is made in Washington. I am really, really concerned that the Senate is going to just take this thing into agonizing detail, that we're going to get down to, it is going to be the first week of July. And I don't like cutting it that close, because if we really do want a serious economic catastrophe, have all the tax cuts from the 2017 tax package revert back to before then, we will have a big problem. So I'm hoping that we can keep the momentum going on that tax package. And look, by the way, I am very concerned about the spending, like everybody else who listens to our show should be. I do believe the U.S. is insolvent right now. That's not bankrupt, by the way. Insolvency means we're not paying our bills, but we can borrow more money to cover the difference. Bankrupt means you can't do that anymore. But we do need to take this serious. We're in the warning track. But, Frank, and I know for our audience especially, as I am now living in Las Vegas as a somebody who was born and raised in California, the SALT exemptions, this is still a real problem. And I think we are gonna go to political blows on this thing, because you can actually, it's just downright emotional with certain senators. Mm-hmm. You have, we have the senators from California or the senators from New York or Illinois trying to say that, hey, look, we're not going to go in favor of anything if we don't get some reprieve from our state taxes. But then you will have states such as Nevada or such as Utah or such as Texas saying, hey, wait a minute here. Why are we having to give you guys a deduction for the fact that you live in a poorly run state? Why is that our problem? Again, this is sausage making. We could have a whole show and it would probably end up getting overly emotional. But these are the kind of things that we're going to hear a lot about between now and July. And me personally, I think this is a lot more important than the tariff issue. It really is.
It's not only a big bill, but let's remind it's a big, beautiful bill, as the president has called it. The Senate did return from recess just today, by the way, to negotiate the president's spending package after this passed by the way, just a single vote in the House. Now the Senate going through this process, this sausage making, as you say, which nobody wants to see or hear about, but it has to happen. So let's see how all this plays out here. But there could be tremendous drama here from what we've been talking to Grover Norquist and others who follow this very, very closely. And Ken, so let's stay on that. We'll continue the conversation here in just a moment. You're listening to Winning with Winans with top-ranked money manager Ken Winans, WinansInvestments.com. We'll continue in just a moment live here on 790 KBC. Welcome back to Winning with Winans. It's Frank Motek here, along with top-ranked money manager Ken Winans, the president and chief investment officer at Winans Investments, WinansInvestments.com. A lot to talk about here and on the economy. We got the latest readings on manufacturing and inflation coming in cooler than expected. The notes from the Fed's last big policy-setting meeting. Ken, how do you take all the latest news in here?
Well, and this is the other thing too, Frank, and I don't think anybody else in media is even talking about this. We are now officially on Jay Powell's last year as chairman. The clock is ticking, and I would say that it's probably going to be the next. I would say maybe not necessarily the next meeting, but the second one after that is going to be a lame duck session for this chairman. So when you think about the Federal Reserve, which has been the buyer of last resort of all this debt generated through this entire century, and you have the chairman who's ending this term who does not get along with the president. The Treasury Secretary is trying his best to balance these two out. But there's just, again, another realm of drama. But here's the thing. The Federal Reserve, which is very data dependent, look at what happened last week. We had manufactured goods down 8%. Then on Friday, we had the estimates about consumer confidence. They were up. Everybody was happy, spending money all through Vegas for the weekend. People are here spending money, gambling, having a good time. And then you had the data come out today that was negative. Oh, and by the way, the housing data last Friday actually came out pretty good. So it's just to say it's mixed economic data. And then to be perfectly blunt, I'm not 100% sure right now when you're looking at the Doge cuts, the people quitting their jobs in Washington, I'm not even 100% sure if I can trust the data coming from Washington and, for that matter, Sacramento 100%, Frank. I'm looking at this stuff. I'm one of these people who's pretty good with statistics. And you just don't have things swinging all over this place. And then the other big thing, and I mark my words on this, if you find massively big revisions when these numbers are revised next month, that tells you that we really don't have a good handle on what's going on. So you have you have companies flying blind on their forecasts. You have data coming from the government. It probably hasn't been this bad since COVID or even 2008, 2009. So it really is trying to trust what the stock market and the bond market is telling you. And for a lot of people, that is a real, real tough thing to do.
On inflation, we did get that, what we're told is the Fed's favorite gauge of inflation in the last week or so, the personal consumer expenditures reading, and that came in cooler than expected. This as the price of oil has mercifully stayed in the low 60s lately, in fact, even cracked below 60 recently. Now there's concern, obviously, with all the geopolitical tensions boiling up again, and we did see oil moving higher. The Fed, of course, focuses on inflation as well as the labor picture. Fed Chairman Jerome Powell, as he said in his last year here now, what do you think we're going to get from the Fed on its assessment on inflation? I know we got the notes from the last meeting, and we're going to be getting the jobs report coming out this Friday. But taking that all in, Ken Winans, so what's ahead for interest rates here?
You know what? If you go back and study history, you'll find that there were long periods of time when the Federal Reserve, and I'm talking about years, where the Federal Reserve didn't touch rates, Frank. They didn't touch it at all. It was left static. And I know for people who have been, and it really goes back to starting with the tenure of Alan Greenspan, is when we started to seeing this drama play out almost every quarter with what the Federal Reserve is going to do with interest rates. I actually think we're going back to an era where the Fed is just saying, look, the safer bet for us right now, when inflation is still not at 2% and probably will never get that low, that for us is to keep rates here and let the banking system, let the mortgage system, let it adjust to these rates. Let it adjust to let things work itself out. And I mean, one of the things that I absolutely love about American capitalism is that we pivot and we think on our feet. All of a sudden you're hearing, especially in markets where the real estate market might not be that hot, suddenly sellers are being told, hey, you might need to carry some paper. That's a throwback to an era of 40 years ago. You're finding that home builders are going to have to step in with their financing arm. The fact that Fannie and Freddie Mac might actually go private again. These are all private sector solutions that are not dependent on the Fed. I think it's healthier in a lot of ways, but these adjustments are difficult. And I know the realtors on this audience are cringing with what I'm saying right now, but if we can get used to an idea that for 2025, that the stock market doesn't do much of anything this year, up, down, finishes the year single digits. Bonds, same way. Mortgage rates, same way. Housing will be volatile, very regional. We'll talk about that later. But if we can just get into a year of I would just say inertia, static, nothing big happening. And I think that's probably what the Fed's going to do. I think that they have no incentive to try to do this. In a weird way, Frank, if the Fed did suddenly start dropping rates, it would tell me that something is really scaring them and the economy is tanking. But I just don't think we're going to see it. I've told my clients, you know what, you're going to have to, the way you make money this year is the old-fashioned way. You have to make good investment choices, and you got to cut your losses. And I think it's going to be the way it's going to be. Hey, Frank, I want to go back real quick on one thing. In a way, as I'm one of these weird people, I actually monitor what is said coming out of Sacramento. And one of the things I caught whiff of, and it actually disturbed me quite a bit, is that based on what happens with the SALT exemptions, might very much determine if California, in fact, plays around with its income tax rate, which I took as if that SALT exemptions go in, the state might very well raise its income tax. Again, I'm not an expert on government policy, but if you're a resident in California, you might need to get political this next couple of years because that's ridiculous. You already have the highest income tax in the land. And the fact that the state is even thinking that way should really unnerve you.
That is an excellent point, which we will talk to our tax watchers, Grover Norquist, who's been on this program. Ken, might be time to get him back on, too, on all of this. So thanks for raising that. And it's hard to ignore gold, near its all-time high again with inflation supposedly cooling down. Usually that's an inflation hedge. Obviously, there's a lot of nervousness around the world, but I know you're keeping an eye, especially on gold, as well as the other precious metals. Silver, by the way, above $34 an ounce here as we speak.
We talked on Motec on Money today, and Frank, you and I, look, I'm going to give you and I credit. We have always agreed that this show is about winning with Winans, not woking with Winans, and we were telling people about the metal plays 2 years ago. And I just think, the old adage, trend is your friend. And I will just tell you that on even a whiff of a dip in gold, people step in and buy. The same is true about silver. The same is true about copper. Platinum is taking off finally. The entire metal complex, which is what we call it in the commodity world, is moving north. They're moving for different reasons, mind you. They're cousins. They're not in lockstep. But I just would tell anybody who's in the audience who's an investor, look, if I had to pick right now between owning gold or owning a tech stock, I would own gold. I mean, mark my words on it, Frank. I'd much rather own gold right now than a lot of the tech stocks. I mean, when I just simply look at the chart patterns of something like Apple or Amazon, I would much rather own gold, hands down. I just think these companies have got some big problems. Oh, go ahead.
One thing we haven't really focused on that much or talked about that much, the good old penny is going away. The penny, which is mostly copper, right, which has also been soaring. That's why all the copper wires are being ripped off left and right at every turn around this town. What about what about your reaction to the U.S. Mint discontinuing the production of the good old penny?
You know what? It's actually been interesting because if we think about it, there's a lot of businesses in this country, including the restaurant industry, which you and I have talked a lot about, where the pennies, excuse the pun, actually do matter. So here's what's going on. Number one, yes, the Treasury Department did put in their final order of pennies. It actually costs nearly 4 cents to make a single cent. Doesn't make any sense. And in fact, they're actually talking about the nickel might not be too far down the path of it also being removed. But it's actually scaring the heck out of a lot of businesses because they operate in pennies. So here's the deal. The actual penny will be around until it's not anymore, but it raises an interesting point. Although we might not have physical pennies, but we might still have digital pennies for the foreseeable future, which, and ironically, might involve crypto. This is a perfect place for a stable coin to come in for companies trying to make their end meet. But yeah, the penny, rest in peace. It's going to go the way of the Eisenhower silver dollar, which was the last coinage that we retired, which was back in 1978.
Wow, so that is very, very big news. So we're going to just stick with the pennies that are already in circulation. No new pennies, and that is very, very big news. And looks like the government is going to be saving, what was the estimate? Well, certainly millions, if not billions annually, right?
Yeah, absolutely. Well, they're doing what they're supposed to be doing. Look, when you are running trillions of dollars of debt, you're doing what you're supposed to be doing. You're tightening the belt, and they're doing it. But the law of unintended consequences, and I do worry about those businesses where those pennies do actually matter. I mean, McDonald's restaurant, the founders of that, they were the ones that said, count your pennies. They were the one that I think coined that phrase, count your pennies. So it does matter. But Frank, here's the thing. When we talk about coinage right now, the other big thing I'm hearing about is the dollar. If you believed what people were saying, you would think the dollar has lost half its value. Folks, the dollar is trading well within the range it has been for the last 10 years. It is nowhere near the lows of 2008, 2009, not even close. Now, for anybody looking at a European trip, it's more expensive than it was 6 months ago, but it's still well within the range. I think that the dollar is going to vacillate back and forth. You talked about with gold, Frank. They're going to be doing it. Crypto's the same way. We're going to have these things bouncing around. But I will say this. I do think we should get used to the idea throughout this summer, entertainment is going to get more expensive, especially domestic entertainment. They're already talking about people are backing off of big, expensive vacations to Europe, and they're looking about being here. I think you're going to find that entertainment this summer, especially when it involves food, especially beef is on a tear right now. Prices are going crazy. I think things like that, you're going to begin to notice that it might hurt a little bit more. But you know what? All in all, it's still going to be affordable.
All right, a lot to talk about as we continue here on Winning with Winans. We're going to hit on crypto, too, and the whole works as we continue with Winning with Winans with top-ranked money manager Ken Winans, President and Chief Investment Officer, Winans Investments, WinansInvestments.com. You're listening to Winning with Winans. We are live tonight here on 790 KABC. Welcome back to Winning with Winans. Frank Motek here, along with top-ranked money manager Ken Winans, President and Chief Investment Officer, Winans Investments, WinansInvestments.com. Ken, congratulations once again on your Morningstar 5-star rankings. When we say top ranked, we mean it here. And also, congratulations on your recognition recently by UNLV. Lee Business School presented you with special recognition for your generous support of the students and faculty there. And you're a great educator as well as a great money manager and a great author, too, a Forbes magazine contributor. And it's an honor to be on the air with you live here this evening.
Well, thank you, Frank. And, I would just say to the audience members who have businesses, there is a lot of hardworking young people coming out of trade schools and coming out of really good schools like UNLV. I love the fact they have stayed on point about education, not indoctrination. And these young people are biting at the chomp to get into a company, learn the ropes. And so what I'm just trying to say is don't be afraid to offer summer internships. You might be pleasantly surprised. I know that California makes it a little tough with minimum wage requirements and all that, but I'll just say right now, I've had several interns, and actually one of them became a great employee. It's just a wonderful way to help these young people find their path. But Frank, with that being said, and here we are coming on the last month of the quarter, and I still can't believe it's June, Frank. I mean, this year has been a blur. I mean, my gosh, we started with the fires, the tariffs. It is just the pace at everything, good, bad, and ugly, has happened this year. And unfortunately, although we keep hoping for a reprieve, I just think that the pace of news is going to continue. But what I would say, as we agreed on, we're going to try to score the various segments of the financial markets. And it would almost like the way you handicap a horse race, you need to actually begin to handicap this thing. And I'm just going to start off with, in spite of all the really wacky and downright awful things that have happened this year, who would have ever guessed in late April that the stock market, the U.S. stock market, would be at a break-even point, and I dare say actually in the black? That has taken an awful lot of hits, my friend, and still come back strong. And I think, again, anybody who wants to try to point to doom and gloom and that we're getting ready to go off a cliff, well, I mean, I've monitored and I've written about an awful lot of bear markets that have gone back historically. And I will just tell you, as of right now, this is not how bear markets get started, period. This is not how they end up this way. And especially when you look at the stocks themselves, and I know we talked about Motec and money, but I think it's so critical. There's a lot of people out there who they've gotten so used to just buying the market, buying an index fund or buying an industry index fund. And I'm going to throw this out to you. I think in order to make money this year, and by the way, while we're on it, I mean, I've had people, again, saying how unbelievably weird this market is. It's never happened before. Well, let's go down a little walk down memory lane. 2005. S&P 500 finished the year up 3%. 2007, right before all heck broke loose in 2008, market ended the year up 4%. 2011, absolute goose egg. S&P 500 even on the year. 2015, -1. 2018, -6. Then we all remember 2020 with COVID. This is my point. This is not a black swan. This has happened before. Single-digit miserable years. I mean, those years I rattled off, I mean, I probably have to go back and look at why they did what they did. But here's my point. Investors should basically have a strategy that would allow you to adapt when you have these kind of volatile single-digit years. And I'm going to suggest to everybody who's listening, that means you've got to abandon what makes you money when the market goes up 20, 25% a year. And the way you're going to do it this year, if you want to make money this year, you're going to have to look or hire an advisor who will buy you individual stocks. Forget index funds, forget industry index funds. A good case in point, the restaurants. The restaurant ETFs this year, but they're negative. Yet I can find you 4 or 5 restaurant chains or retail chains that have done very well. You've got to go back to basics. And right now, it's about, as Warren Buffett would say, it's not a stock market, it's a market for stocks. And people need to go back and look at individual securities.
On the air live with top-ranked money manager Ken Winans, and boy, this year has flown by. The days are long, but the years are short. That is certainly something we're being reminded of this year, as we're just about halfway through 2025. It's hard to believe. And speaking of individual stocks, Ken, certainly NVIDIA, the Magnificent One, getting a lot of attention on its impressive rebound. Was below $100 and now is at around 137 here at last check. Netflix hitting it out of the park with the record highs, and in the streaming world, watching that one very closely. And Tesla, too, had an impressive rebound, 342 or so at last check. What about those big names that people talk about at cocktail hour?
Well, I'll tell you what, the other one, when Mojang Money, I threw out one of my new favorite stocks is Spotify. I mean, so anything that's in the tech world that deals with streaming, certainly Netflix and Spotify, they're killing it this year. When I look at what I would call the tech stocks that I target each and every day, I mean, yes, I mean, you're right. NVIDIA had one heck of a bounce back. I mean, certainly anything else tied to AI also has. But the simple fact of the matter is, I'm looking at that, and I'm looking at, and yes, and NVIDIA is still up. If you were to ask, in the last 18 months, it is up basically about, what are we looking at, about 75%? Well, guess what? Gold's up 63. Gold is up 63. Gold has almost matched NVIDIA. I mean, that is astounding when you think about that. And I don't think anybody would bet on it. So my point is, I think there's going to have to be a clarification, and I think people have to go back and really think about their discipline. You have one of two choices here in this market. If you want to try to play the volatile game and try to trade your way through some of these tech stocks, great. Good luck. Stay with your course. But I think the typical investor would be wise, by all means, have NVIDIA in your portfolio. But many people were way over-concentrated in that one stock, and they paid dearly for it. I'm just simply saying I can find you a lot of turtles out there that are beating the hares right now. And you might want to take a look at some of those turtle stocks in those old industries. And right off the bat, I mean, here, this will blow people's mind. Costco. Costco was up 60% in the last 17 months. Costco. I mean, I think people have just got to, they've got to quit just focusing on tech. Look at these other stocks that are doing well. I mean, look at JP Morgan. It is up 56% in that same time frame. Again, they don't have the sizzle of the techs, but you own stocks to make money, not because they're glamour names. And I think that people do need to do some soul searching on their strategy going through the rest of this year. Because I'll tell you right now, Frank, the volatility is not going to end. I think if you get any news that comes out of China that has something to do with AI, that could slap the entire group senseless. So you just got to realize you're in a very geopolitical play.
On the air live with top-ranked money manager Ken Winans, President and Chief Investment Officer at Winans Investments at winansinvestments.com. They're smart at Costco, Ken. They sell gold there, too, now, by the way. A lot of people
yes,
make note of that and talk about that. And before we end the segment here, I want to ask you about so-called digital gold. A lot of people, of course, are paying attention to what's happening with cryptos, especially since Bitcoin roared to a record high recently. So what about digital gold, Bitcoin here?
You know, all the cryptos are very technical, and if you're going to play them individually, you really do need to start using technical analysis tools to analyze them. The one that I pay the closest attention to is that relationship between Bitcoin and NASDAQ. We can't explain it. It might make some abstract logical sense, but it's very much in place. But I still think we go back to what we talked about earlier, Frank, about what's going to affect the next 24 months. That deregulation, once they get the tax package done and they can really focus on, as they're putting it, modernizing the regulatory landscape, I really do believe that within a very short period of time, people can go to a bank, any bank, and they can actually get a crypto savings account. They will be able to go to a brokerage house. And although they'll be able to not just buy an ETF, but they'll actually be able to have a wallet. They'll be able to actually do crypto. That is all coming. I mean, whether you like crypto or not, it is coming your way. But with that being said, I think that for people, there's just a lot of new, what I would say, very stable ETF products out there. And unless you are really going to learn the ins and outs, I'm still dealing with some of the fear of what happened at Coinbase with the hacking a few weeks ago. And I've had to remind people, look, this is not a stock. You have to learn about the ins and outs of crypto. And that also means cold storage. But again, my point is, whether you like it or not, it's coming. And it's going to come in the final leg of the Trump agenda, which is deregulation. And so, yeah, I think it's safe to say that Bitcoin is going to continue hitting new highs as we go into 2026.
All right, we will continue the conversation. A lot more to talk about. I know you want to hit on the real estate as well, and want to talk about your real estate index as well, Ken, and what's your outlook on the residential as well as commercial. And before you know it, it'll be wine o'clock. We'll talk about wine and a lot more to talk about coming up in just a moment here. Winning with Winans. We are live with top-ranked money manager Ken Winans, President and Chief Investment Officer at Winans Investments. Website, winansinvestments.com. We'll continue in just a moment live here on 790 KABC. Welcome back to Winning with Winans. It's Frank Motek here along with top-ranked money manager Ken Winans, President and Chief Investment Officer at Winans Investments at winansinvestments.com. And Winning with Winans also airing in Las Vegas these days. And Ken, you're big on the business scene there in Las Vegas, and maybe you can give us an update on what's happening there today.
Well, it's actually interesting. Nevada is very different than California. We have a part-time legislature that meets every 2 years. These people are not paid much money. They're actually very, I downright say, frugal on how they spend money, Frank. But these are the issues coming out that was very interesting. We're still dealing with the land issues, the power, and I'm talking about regionally, California, Nevada, Arizona, Utah, everybody in the western states are dealing with land, water, and power. There's going to be, and mark my words, a lot in the news about this. 2025 is the renegotiation of the Colorado River Pact between 14 states. And I think California is probably not going to be on the winning end of this thing because all these other states have gained in population. So expect to see news there. There's continued disagreement, by the way. Bureau of Land Management, better known as BLM, is releasing land. It's part of the thing on, that California needs the land, Nevada needs it, but there's a real fight going on between Republicans and Democrats about the use of that land and the environmental consequences. So you're going to be hearing more about that regionally. Believe it or not, in the new big, beautiful deal, with the cutbacks they're talking about in some of the government programs, they're expecting companies to offer more in the way of 401ks to their employees. And they're talking about companies with as few as 4 employees. So expect more there. But Frank, the other big news, I heard it straight when I was there. It's the migration from California to Nevada. And there was a very interesting piece I caught in Barron's Financial Weekly. It said that the percentage increase of California's population in 2024, it was 0.6%. That was the gross increase. They said it was almost completely from global immigration into the state, meaning immigrants. And yet at the same article, it talked about the 2 cities losing its population the fastest are San Francisco and LA. However you want to dice it up, California's losing its taxpayers. And that is going to really play, I think, as we go through the remainder of this year and certainly going into the governor's race. The people of this show need to be paying attention. There's some real problems there. But Vegas and Nevada itself, look, nothing's perfect right now, but our real estate market is strong. You have a lot of people moving here, and it's just a great business environment, Frank. I constantly talk to people who have relocated here from California, and the phrase is constantly, they would never go back, ever. You couldn't pay them to go back, and that's with 100 degrees days in the summertime here.
Let's talk about real estate. Obviously, this market here in Los Angeles has been dealing with some unusual situations, the horrific firestorms and the ongoing recovery in the Palisades in Malibu, as well as in the San Gabriel Valley and Altadena area, and that is impacting things here. And generally speaking, Ken, what you keep an eye on the LA market here and mortgage rates as well, which have been elevated lately. What do you see ahead on the real estate front? And tell us more about your real estate index.
Well, the real estate index I have is, it was partly because Case-Shiller was always had a 2-month lag, and I felt it was important for me as a money manager that I needed a better gauge of what was going on in real estate. So I developed an index many, many years ago that really focused on new housing, and it broke into geographic regions. What I can tell you is this, and I'm also concerned that, the home building stocks are still having an awful year. I just don't think that, and you talked about the tragedy of what happened in Southern California, especially the LA area with the fires. The building is going to be slow, getting materials, getting workers, just all those kind of things. It is a monumental task. And what I'm hearing out of California is Orange County, because people have left LA County, they're going down there. They've driven up housing prices in an already inflated market. And then I'm also hearing about, just going east, going in Inland Empire. And again, people are really stretched right now, but they need to find a place to live. Unfortunately, that story is going to continue. But again, I talked about the migration issues. Literally, that I think we're going to read more and more about that. When you start backing into the math and realize what you can buy a house for in the Las Vegas area compared to paying for an overpriced house in Inland Empire, I think people are doing the math. And more important than that, the employers are doing the math and saying, you know what, that's it. We're going to begin the relocation process. But Frank, getting back on a couple other quick things, I want to talk really quick about the bond market. The stalwart of this entire year has been corporate bonds. They barely burped all through the correction. I'm having more and more people saying they want to put bonds in their portfolio. And these are not people needing the income. They're looking at right now, if they can get 6.5 to 7% on an industrial bond, and they're looking at the stock market for the next 24 months, can they average 7% per year? Probably not. So I think that relocation is going to continue. And then we talked about commodities. I know that we know what's going on with gold and oil, but I dare say that anybody who has cattle interest up in the Central Valley of California, you're probably going to be very, very happy when you start getting your dividend checks, because cattle, both feeder and live, they're at record highs right now. And that's going to continue as well. But Frank, final thing on real estate, if I had to place my money right now, money's flowing back into real estate investment trust, better known as REITs, and it's mainly commercial. And they're looking at the fact that people are going back to work in buildings, and that means the entire complexes are coming back to life with restaurants and shops and all that. That seems to be the big play right now. It really is a big deal.
Do you have any favorites in that space? Apartment buildings are certainly big as people can't afford to buy a place. That seems to be a big topic of conversation, and that slow return to the office continues, and a lot of talk about how commercial real estate may have bottomed out in a lot of places. And certainly it's very interesting to see what's happening here in the Los Angeles area with Century City, one of the few places where they're building an office tower, by the way. Don't see that very often, but the occupancy in Century City, which is beautiful, is quite high, whereas in downtown, as we heard from one of the top people in commercial real estate here, is still under pressure. So what do you see ahead on the commercial real estate front?
You know what, I would go with my big three, and they are this in following, and I'm not and just because they are the players that have survived the storm. I would look at Vornado Realty. When you're talking about office buildings, office towers across the country, they've been around since the 1970s. When you're looking at malls, I would take a good look at Kimco Realty. We've all gone shopping there. And then let's face it, there's an awful lot of people out there still storing their stuff. Go look at Public Storage. So, and then Avalon Bay on apartments. I think those are the kind of the guys that I would look at is stay with the bigger guys because their costs of operating are lower and they're geographically diversified. But there's just all through the weekend there was talk about that real estate is really coming back to life. But Frank, one other quick thing, and I know we're going to get into wine here real quick. Market seasonality, I often talk about it. We said earlier in the show about sell me and go away. But what I would really tell people in this kind of very volatile tug-of-war, whipsaw kind of market, you need to get rid of your losers. And if you have a stock, and I don't care who the CEO is, the product, the name, any of that, if this stock is not doing well, and you're already through the year and you've made, in other words, the stock took a hit, did not rebound with the market, I'd get rid of it. I'm sorry. Come back and fight another day. Buy it back in the future, but go into something that's making you money right now. So people should be selling their losers, and I think even with tax strategy, it makes sense. But my friend, I want to get into the wine thing Because
yeah, let me get my glasses, wine glasses, that is. Yes, sir. It's wine o'clock.
Well,
go right ahead.
I wish you were here, buddy, because you and I cannot drink wine in the studio, but I have to admit, I confess, I've been enjoying a wonderful red wine while we've been doing this interview. Last segment, I talked about Trump Wines, and this is the winery owned by Eric Trump in Virginia. You know what? We talk about trying to find, wines that are good, that are just not over the top in price. Well, I'll tell you what, I've been having a Trump Meritage, wonderful. It's from Virginia. It's not a California wine. But, Frank, I got to tell you, it's a darn good wine. And I think since our audience are people who typically bend a certain political way, I'll throw it out to you. Trust me, if you go, join their wine club. It's not going to break the bank. You'll get some wonderful wines. By the way, they also send you an order of truffles along with your first order. And if you really want to have fun annoying some of your relatives and friends who are still griping about the election, pull out a bottle of Trump wine. You'll have a lot of fun while you drink a really good wine.
That is fantastic. I was in New York years ago, and some of the wine shops near the Trump Tower there offer the Trump wines as well, and even Trump champagne was fun to see that. And they're online, right? So you can get them pretty much wherever you want nowadays.
You know what? I'm not kidding you. You know what? And Frank, I'm a California wine snob. I like California Reds. And by the way, this wine I'm drinking right now won a gold medal in San Francisco. So I'm sure the Pelosi clan is probably rolling right now thinking that a Trump wine won an award. But it's really good wine, I have to tell you. I've enjoyed it.
Fantastic. Well, I'm going to say cheers to you, Ken. And what's the best way for the folks to reach you, sir?
Go to wineandinvestments.com, and please keep sending us your questions. We'll be happy to bring it up on the next show.
Well, fantastic. Ken, it's always great to have you with us here. We look forward to our next conversation on Motec on Money coming up, as well as a week from today, Winning with Winans. I've been speaking to top-ranked money manager Ken Winans, the president and chief investment officer at Winans Investments, which you can find at wineandinvestments.com. Be sure to check out Ken Winans' latest book, Investment Atlas 3, Creating Wealth Using Historical Trends. He's also a Forbes magazine contributor, so be sure to check out his latest articles. Most importantly, host of Winning with Winans, heard every Monday night at 6 p.m. on your favorite station right here, 790 KABC.
Expert entrepreneur Ed Mylett is on a mission to max out your life.
We're throwing open the metaphorical closet doors of our lives. We're going to be cleaning out the closet. What no longer fits? Audit some of your relationships. How about auditing your emotions? Maybe it's your career you need to look at. Get your life together for this season.
The Ed Mylett Show.
It's time for a little cleaning of the soul. Let's get a little ruthless, a little refreshing, and a little real. God bless you, everyone.
Follow and listen on your favorite platform.